Hi everybody. So this week we are looking at chapter 12 in the text. So I'm going to briefly just run through a few little things in the chapter, some terminologies that you should know, or just point out some sections to pay close attention to. So one of the terms we're introduced to is relevant cost. So a relevant cost is a cost that differs among alternatives. So you're going to have more than one alternative to choose from. Everything that's the same between the alternatives we don't take into account. We only pay attention to any costs that are different under each alternative, and that will be incurred in the future. So if it's something that's already been incurred, paid, and done in the past, we don't use that in making our decisions. So relevant cost, different among the alternatives, and incurred in the future. So if we look further down, avoidable cost, so that's something that can be avoided or eliminated by choosing one alternative or another. This here is of particular importance. Two broad categories of cost that are never relevant in decisions. So they are irrelevant cost. Sunk cost. So a sunk cost is something that's already happened. The example they give here, a previously owned computer used to download a movie. So the computer was already purchased. So it's something, the money has already been spent, it's already been incurred. There's nothing, any future decision is not going to be affected by that cost. You can't change it now. The other cost that's not relevant or irrelevant cost is future costs that do not differ between alternatives. So again, any costs that are the same between the choices that you're trying to choose between, then they don't make a difference to your decision, and they're only going to confuse you and clutter up your decision, so we leave those out. So here they talk about avoidable cost, differential cost, incremental cost, relevant cost. These are all pretty much kind of the same thing. Avoidable, something you can avoid between choosing one alternative over another. Differential, costs that are different between one or another. Incremental, the extra cost that comes into play. Or relevant, and seen above, relevant is was identified up at the very beginning up here. Differs between alternatives and it's future oriented. Okay, so we did there. So we keep coming down. Yeah, I hate on the screen here. I can't figure. Here we go. Where did we leave off? Here. Okay, an avoidable cost here. That's something that can be eliminated. Oh no, we already did that. We were down here. Okay, sorry. I don't think there's anything else in this section. Okay, so moved on to the next section. I'm just going to take a look at the learning aid. So here we're looking at keeping or dropping a product segment. So relevant things that need to be taken into consideration is the contribution margin that is lost if that product or segment is dropped. Also, fixed costs that could be avoided if that product again or segment is lost. So not all fixed costs, because some of them are going to be incurred either way, whether the product is still there or not. It's only the ones that are going to change if you make that if you keep or drop that product or segment. And the contribution margin lost or gained on other products or segments. So in some cases, if you drop one product, maybe sales in another product that you have will increase. Maybe one could have replaced another, for example, and sales could have increased. Or maybe they're kind of related in the sense that if you drop it, one product or segment, maybe sales in a related product or segment could also decrease. So the contribution margin that is lost or gained there then would come into play in your decision. But again, like we mentioned a few seconds ago, irrelevant costs, allocated common costs is one. So common costs that often get allocated out to different products or segments based on volume or whatever criteria they want. They're just allocated based on some criteria to that product or segment. They're going to be there whether that thing is dropped or not. And sunk cost, money that has already been spent in the past, and no matter what decision you make in the future, that money's already spent, you can't get it back. So those are irrelevant. So your decision rule: keep if the contribution margin lost on all products or segments is greater than the fixed costs that can be avoided plus the contribution margin gained from other products or segments. And you want to drop the product or segment if the contribution margin lost is less than the fixed costs avoided plus the contribution margin gained. Okay, we'll move on to the next section. I want to touch briefly on opportunity costs. I want to make sure everyone understands what this is. Opportunity cost is what you gave up to do something else. So something totally unrelated to this here, for example, but in personal life. If you have this evening, you have a choice. You could study or you could watch TV. So the opportunity cost of doing one of those things, the opportunity cost of spending your evening watching Netflix, for example, is the fact that you now aren't going to get to study. Or the opportunity cost of studying this evening is that now you can no longer spend your night watching Netflix. It's what you gave up to do something else. Okay, so now we're moving on to make or buy decisions. So again, we're just going to review the learning aid because it kind of summarizes what was read before there. So relevant costs in this decision: incremental costs of making the product, both variable and fixed. So if you're going to make the product, what additional costs are you going to incur? Additional variable cost and additional fixed cost. Also opportunity cost of utilizing space to make the product. So obviously if you have a plant or as such and you use the space and the machinery and whatever to make a product, now it can't be used to make something else. So what are you giving up? And also the outside purchase price to buy the product. So these first two here are more related to making the product or purchase price to buy the product. Those are relevant in your decision. Irrelevant costs, again, allocated common costs. They are common costs that are going to be there whether you make or buy. So they don't make a difference. They're just allocated out based on some criteria. And sunk costs. So total relevant costs of making the product are equal to the incremental costs plus the opportunity costs. Then you would compare that to the purchase price. So in your decision rule then, you make the product if the total relevant cost of making the product, so the total relevant cost here, if it's less than the purchase price, then you make the product. If the total relevant cost of making the product is greater than the purchase price, then you go ahead and purchase your product. So now we're moving on to accepting or rejecting a special order. So a special order is usually like a one-time thing. It's not part of your normal operations. It's a special request to fill an order, for example. So relevant costs and benefits that need to be taken into account in your decision are the incremental costs of filling the order. So again, that's both fixed and variable costs, anything that's going to increase because you're taking the order. Opportunity cost of filling the order. What are you giving up? Was that idle space or idle capacity, I should say, or would you have been making something else and have to give that up in order to fulfill your special order? And we also have to look at the incremental revenues from the order. And again, irrelevant costs are going to be your allocated common cost and your sunk cost. So your relevant costs then are going to be your incremental cost, both variable and fixed, and your opportunity cost. And then we're going to compare that to the incremental revenues. And if our incremental revenues are higher than incremental costs, you're going to make more money than the costs that you're going to incur, then you're going to go ahead and accept that special order. If your incremental revenues are less than the cost, then it's going to cost you more than what you're going to make to fulfill that special order, so then you're going to reject. The next topic in the book is sell or process further decision. So some of the terms, joint products, joint product costs, split off point. We're just going to look at this exhibit. It's exhibit 12-6. That's on page 548. So here, for example, we have wool. Wool that goes through a separation process, and after that process there are undyed coarse wool, undyed fine wool, and undyed superfine wool. So 3 products. So here is the joint cost. These two things here, the cost of the first product and the cost of the separation process, are joint costs. And from there we have 3 different products, and this is the split off point. It splits off here into 3 different products. So the decision here then is to sell or process further. So you're going to go through this process to get your 3 different products. Do we sell these products here, or do we process further? So do we take each product and do further processing to come up with a new product? And we're going to look at the criteria for making that decision. So if we skip on down to the learning aid, sell or process further, we can see that the relevant information would be the incremental costs of further processing and the incremental revenues from further processing. And irrelevant to our decision are allocated joint product costs. So I'm just going to go back up to the, here we go to the thing. So incremental costs, so the costs here of processing further, the incremental revenue of processing further. So the incremental revenue we're given, for I'll take one for example. The sales value here is 120. If they process it further, the sales value is 160. So the incremental revenue is the difference, the 160 minus 120. So if they process further, they're going to get an extra 40,000. The incremental cost is 50,000. That's extra processing that has to take place. So they're going to spend 50,000, but they're only going to make 40,000 extra. So not worth it. What doesn't come into play are these costs, because this has already happened. If we sell it here or we process further, this is already done. It doesn't, so we can't take this and allocate it out to the products, as it would skew your decision. So allocated joint product costs don't come into play when you're making your decision. So again, your decision rule: process further if the incremental revenues are greater than the incremental costs of further processing, and you're going to sell at your split off point if the incremental revenues are less than the incremental costs of further processing. One last thing I wanted to point out in this chapter is on page 551. Profitability index. It's the contribution margin per unit of constrained resource. So what this means, we all know contribution margin per unit. So just for example, if we had a constraint and we could only do so much of each product, you'd look at this and you'd say, well, our contribution margin for a mountain what is that? Is that an L? Anyway, this product, you would say the contribution margin's higher, so we should make that. But you have to look at it based on units of the constrained resource. So in this example, the time on the stitching machine, that's where the constraint comes into place. So time on the stitching machine required to produce 1 unit. It takes 4 minutes to do 1 unit. So the contribution margin per unit of the constrained resource, so there's $10 contribution margin per unit of item, of these things, but it takes 4 minutes to make one of these things. So each minute then, if you divide it out, it's 2.5 per minute. So the contribution is $2.50 per minute. Whereas here, it has a lower contribution margin per unit, but it only takes 2 minutes on the machine. And the machine, again, is where the constraint is taking place. So that means for every minute, it's earning $4 in contribution margin. So now, because of the less time this takes on the machine that's causing the constraint, this